Hi, this is John Coumarianos with Mindful Advisory, bringing you a segment called Driving Returns, where we look at a few charts and maybe some other things going on in the markets that I think investors would like to know about. This week we'll start with a couple of charts. The year is young, it's February 3rd today. If we look at the year to date, so that would be January 1st through February 2nd performance of the S&P 500, the index is up 4%. That's pretty healthy gain for just a little more than a month this year. But if you look at the equal weighted version of that index, so take the 500 stocks, don't weight them based on their market value, but weight them 0.2% of another index that you've created. All of a sudden, that index is barely up for the year. So again, it's kind of a repeat of last year where we call them the Magnificent Seven. Seven big tech stocks carried the index. Those stocks are doing very well again, and the equal weighted index is not doing very well. So if you subdue the weights of those big stocks, you don't get much of a return. The exception is Tesla. Tesla is having quite a bad year, down more than 20%. But otherwise, the big tech stocks are doing well. Also, if you look at the S&P 500 versus the world stock market minus the U.S., so the whole rest of the world, that index is down. The rest of the world stock market is down 1.4% for the year, again, through yesterday, February 2nd. So again, the U.S. leading the way, U.S. tech stocks in particular leading the way. It's a repeat of last year. It's hard to know how long the U.S. stock market and U.S. tech stocks in particular can be the darlings. I think it's reasonable to be suspicious of that, but trends sometimes last longer than anyone thinks they will. But good to be suspicious, I think, and maybe get a little more equal weighted exposure and a little more international exposure. That would not be unreasonable now, I think. Last thing, third thing, Jason Zweig, a longtime veteran Wall Street Journal financial columnist, maybe the dean of financial columnists at this point in his career, had an excellent article this weekend in the Journal about bond funds that are holding bonds that are trading way under par or their face value. 2022 is a terrible year for the bond index, which it was down 13%. It's a loss no one's ever really seen involved in markets today before. And so many big funds are holding bonds that are trading below par. If you buy the fund and the bonds appreciate and they mature at face value, assuming no credit problems, you'll get a capital gain out of it. And investors in bigger tax brackets tend to pay less taxes for capital gains than they do on interest income. So that can be beneficial. And Zweig runs through how someone could look at a bond fund's annual report and see if it's see if the fund is sitting on bonds that are trading below their face value. But I think it would be good for investors to ask their advisors about this. See if your advisor is interested in doing that. Anyway, this is John Coumarianos again for Mindful Advisory and Driving Returns on February 3rd in northern New Jersey, signing off. Thanks for watching.